We're back with an update to a story we first brought you last week on a new private credit ETF. All the rage, of course, is private credit. Bob Pisani has some new details as the SEC says maybe not so fast. Talk to us.
Well, not exactly, Scott, but we want to bring you an update on this story we brought you last week. The SPDR SSGA Apollo Public and Private Credit ETF, that's a mouthful, but it launched last Thursday. It allowed retail investors to buy into private credit assets. And late on that day, the SEC sent a letter to the company saying there was, quote, significant remaining outstanding issues, close quote, and listed worries centered on the fund's liquidity, its name, its use of the name Apollo in the title, and its ability to comply with valuation rules. State Street did respond Friday night, saying they would revise the name of the fund as soon as practicable, presumably removing Apollo's name, clarified that the fund's illiquid products will not be exclusively tied to Apollo, and that other broker-dealers can provide quotes. And finally, that the fund's net asset value, or NAV, will be calculated on a daily basis. State Street told CNBC they would have no further comments at this time. Still, trying to get private credit and private equity into an ETF wrapper is all the rage right now. Let's talk about this with Joanna Gallegos. She's the co-founder of BondBlocks. She recently launched a competitor, the BondBlocks Private Credit CLO ETF. Joanna, I want to talk to you about your fund, but I got to ask you about this. You had a lot of experience filing ETF registrations. You know a lot about this. You know a lot about the SEC. It seems to me unusual for a fund to become effective and then get a lot of questions after the fact from the SEC. Is there any sense of what happened here? I know this isn't your fund, but can you educate us a little about the process?
It's very notable. It's not that it has never happened, but it's a notable part of the process where usually issuers want to satisfy those concerns of the SEC as they're bringing them up in the registration process. That makes sure that, you know, in the way you're going to run your compliance programs, the way you're going to run your portfolio, everything's buttoned up before you go effective. So while it's a technicality that, you know, you could go effective before you satisfy some of those questions, it's more of a standard best practice, good relationship with the SEC, and also sort of translates to investors' due diligence that they understand that everything went through to the satisfaction of, you know, the oversight of the SEC.
And people have to understand, normally when you apply for a fund, it's 75 days usually. It will become effective unless there is issues that the SEC might have. They did have some issues. Yeah. They were extending it a few times, but then they just went public, and then afterwards they had, we have other issues. That's what's a little unusual to me, right?
It's like I said, it's a technicality in the registration process. And, you know, I think that State Street did address those issues the next day. I think this whole part of the registration process and, you know, putting private assets into an ETF, it's really important to satisfy those liquidity and those valuation issues so people understand how it works.
Let me talk about your fund. You've got a competitor, Private Credit CLO, Collateralized Loan Obligation ETF. It invests 80% of the assets in private credit, collateralized loan obligations. Just very briefly, how does this work? Why is this a good way to get at private credit?
Right. So PCMM holds CLOs, and CLOs are packages of loans to small and mid-sized companies in the United States that happen to be private. These loans are used by these companies to run and operate their businesses every day. In a CLO, you might have about 100 of these loans. PCMM owns 42 CLOs. So this packaging of these private credit loans into the ETF allows investors, in the case of our product PCMM, to have direct exposure to over 4,000 of these loans. The coupon payments that are much higher in these loans, and so higher coupons. Low duration, ultra low duration, and, you know, true diversification. This is a hat trick of a product.
Enlighten us. When you buy into private credit like this, what exactly are you getting? How do you use something like this in your portfolio? What place does it have?
Okay,
for the viewers, explain this.
So first, it has a very attractive yield profile. You know, this portfolio is yielding over 8% at this moment. But that true diversification point, I want to pause on it, because private assets, like these private credit assets, have no correlation to public markets, either fixed income or equity. This is a powerful diversification tool that wasn't accessible by investors until PCMM came to market. This portfolio is also 80% private credit exposure. So that's important. You know, in comparison to competitive products, delivering a full portfolio of this exposure is incredible. The higher yields and the low duration also means that it's a low volatility product, and that's what clients are looking for right now. Investors are trying to scramble to get access to private assets.
Okay, this is a lot to digest, folks. We're going to have a lot more coming up on the use of private credit and private equity in ETFs. That's coming up on ETF Edge, 1:10 p.m. Eastern Time. Joanna is going to be joined by Todd Sohn. He's the head of ETF at Strategas. We'll talk about the risks of investing in private credit in ETFs and whether all this interest represents some kind of peak at all. Interesting debate here. ETFedge.cnbc.com.